Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem and noisy numbers to give you the information you need to make the right trade for your portfolio. I'm your host, Allie, Canal, in for Jared Blickery, and with me today is Yahoo Finance senior reporter Brooke DiPalma. Today, we're diving into the Fed's balance sheet and the central bank's continued easing cycle, because by this time the episode airs, we'll know the latest on the Fed's rate decision. Our guest today is calling this next phase for the Fed T-bill and chill, which also happens to be our phrase of the day. It's all about the central bank's plan to load up on short-term treasuries. And on today's Market Show and Tell, we're talking rate volatility. Earlier this year, yields surged with the 10-year briefly topping 4.8%, but now it's back below 4%. So what is that telling us? Is the market starting to price in a softer economy or just getting ahead of the Fed's easing cycle? And our number of the day is $375 billion. That's how much global spending on artificial intelligence is expected to hit this year, at least according to UBS. And it is forecasted to reach $500 billion by 2026. How is this massive wave of AI spending showing up in U.S. Treasury rates? Joining us now to discuss this and so much more is Guneet Dhingra, head of U.S. rate strategy at BNP Paribas. And Guneet, welcome to the show. It is widely expected that Powell and company, they're going to cut rates by another 25 basis points. But the bigger question to me is what comes next. Do you think this is only the beginning of a long and continuous easing cycle to come?
Yeah, thanks for having me on. Pleasure to be here. So I think the Fed decision today, obviously, it's pretty well telegraphed. We have a 25 basis point rate cut coming today afternoon. But I think what's the real question, exactly as you asked, is what lies ahead. And I think starting with today itself, while the rate decision won't be a surprise to anybody, there is still some debate about what is the plan for the balance sheet. And this is where I think there's a lot of sort of the unlearning and learning one has to do to understand how the balance sheet has been evolving so far and what's the path of this going forward. Just to set the ground here, I think the balance sheet matters a lot because liquidity in the entire financial system, ultimately the starting point of that liquidity is how much easy is the Fed with its balance sheet. And so the fact that the Fed in the last probably 2 years or so has been in this unwind process from the excessive balance sheet expansion that we began around COVID, that process known as quantitative tightening, or QT, is most likely going to come to an end either today or in December. And so the first checkpoint for investors at today's meeting is whether the balance sheet is going to end today or December. I think choice between today and December is perhaps more symbolic or more just sort of a formality in the most part. But the real question then is, once the Fed is done ending its quantitative tightening program, what lies ahead? We think at BNP, this is going to be a phase where in the coming 3 to 6 months, the Fed is going to start re-expanding their balance sheet. So today, I think the focus from what Powell says is, what's the plan for stopping? How long do you want to stop? And what's the plan for re-expanding the balance sheet? This is where the T-bill and chill really comes in. So,
well, hold on. You're jumping the gun here.
Let's get to that. The phrase of the day is that T-bill and chill. BNP, as you just were noting, they've been calling for this next chapter for the Fed with the end of quantitative tightening now on the horizon. Can you start just by breaking down what exactly quantitative tightening actually means for our viewers?
Yeah. So look, back in 2020, when the markets had a massive stress episode with the onset of the COVID pandemic, I think the Fed required to deliver some easing measures. Now, we know one of the problems with the zero lower bound is the Fed can only take rates lower up to a point. As an instance, if you think about March 2020, the Fed lowered the rate from 1.5% to 0%. And that was not enough easing, given that the economy required much more support, given the depth of the disruption caused by the pandemic. So what the Fed did, and as they did in the post-GFC period as well, they used their balance sheet. They provided a lot more liquidity and money in the system as a way by buying a lot of treasuries. That way you flush the banking system with a lot of liquidity. And the hope is that increase in liquidity in the system will find its way through the financial system and ultimately the consumer and provide easier financial conditions.
So, how much attention should investors be paying to QT versus QE? Because it feels like what gets the attention is whether or not the Fed cuts rates. Should this be more of a part of the digestion period when investors tune into this press conference and read the statement?
Yeah, so it's a good question because most other times, most other FOMC meetings, the active policy tool, that's the phrase the Fed uses, is the rate policy. So exactly as you said, the rate policy is the one where people are usually focused on. But in this particular instance, because we have this checkpoint where this multi-year process of unwinding the COVID excesses is coming to an end, I think this one requires a little bit more unique focus. The focus also becomes more unique for this meeting because we don't have data. The government's been shut down for a month. The Fed doesn't have much to talk about in terms of the economic progress and the usual indicators they follow. So I think this is why in this particular meeting, I expect the balance sheet to be the primary focus.
One thing that is interesting is what you said is sort of eventually this supplies money to the consumer. But right now we're seeing this K-shaped economy. High-income consumers are increasing their spending where low and middle-income consumers are pulling back. So based upon what is expected today, how does then eventually trickle down to you and me?
Yeah, so it's the transmission mechanism of this liquidity provided by the Fed has always been a question of like a lot of intrigue because critics will say, looking back at the last 15 years or so of trying to do the QE in the system, the transmission mechanism to the consumer is not very clear. Oftentimes, this is phrased in terms of what they call the wealth effect, which is also where the AI debate comes in a little bit, but we'll talk about that. But for now, I think what's important for us to understand is as the Fed injects more liquidity, the idea is financial markets like the liquidity, like the certainty of the availability of money. And as that money filters through financial markets, stocks do well, bond yields are relatively low, that easier financial conditions are expected to help the consumer feel good about the economy and ultimately spend. Whether that translates really in practice is a bit more debatable.
Yeah.
And speaking of debatable, I want to get to our market show intel next. And today we're talking rate volatility. And Guneet, it's not always the exact level that tends to spook folks. It's the rate of change here. We have seen the 10-year that's now firmly below 4%. During the spring Liberation Day tariff announcements, we saw that shoot up. What is the bond market telling us? Is this just investors pricing in more easing? Are there any concerns about the health of the U.S. economy? How do you look at the moves in rates?
Yeah, so the point on rates volatility, I think, is extremely crucial because me as a person who looks at charts all day, what's very interesting is you'll find that the stock market, for example, has a much stronger correlation with rates volatility than the rate level itself. So that just reinforces the point that the volatility or the certainty is sometimes a lot more relevant than the level itself. And one of the few reasons why the rate volatility has been low, particularly I would say in the last 3-4 months, is the Fed has been on this like path for the last 8-9 months where they weren't easing, they weren't tightening rates, so they were like on hold for pretty much 9 months, from December last year to September of this year. When the Fed's doing nothing, I think bond investors find it hard to deviate too much from the priced in Fed path. That is one of the biggest reasons why rate volatility has been low. But then there are other sort of factors as well where because the administration also wants lower rates, and yet investors are concerned about some of these steps on fiscal excesses.
Fed independence, that was a big
independence
question.
is part of the debate. So investors are grappling with this idea where they want to push for higher rates based on concerns on independence, based on concerns on fiscal excesses, but they also understand the administration has tools to keep rates lower. So it's very hard to go too far in one direction. And that's why if you look at the 10-year yield, it's been stuck between 3.8% to 4.6% for the better part of the last 12 months.
So does having low volatility in the bond market, does that change how bond investors should approach their fixed income exposure?
Yeah, so I think low volatility actually makes for less trading opportunities. So that's that's a bit of a challenge. I think I often see a lot of bond investors tell me that they don't have any interesting opportunities to look at. So it just sort of discourages trading a little bit. And what often happens in that case is people don't have much conviction to look at like something outlier. They often like stick to very, true and tried consensus positions, which is one of the reasons why for bond investors in the last 8-9 months, curve steepeners were very popular, right? Because curve steepeners were a way of saying, look, in this environment, I generally know where things are, not much is moving. The safe expression is to do what everybody else is doing.
Just quickly here, there's this notion where consumers, everyday Americans, think that these interest rates translate directly to mortgage rates, but it seems like mortgage rates have largely already priced this all in. Quickly walk us through that, how that could bleed into that.
Yeah, so I think the transmission from mortgage rates, from treasury rates is, of course, pretty straightforward, where if the treasury is able to take steps to lower the treasury yields, which I think they have to some extent in this year, then mortgage rates generally do tend to follow. And I think ultimately the question is Fed cutting rates the answer to getting mortgage rates lower? We know the administration would want that. I think generally consumers would want that. But the problem is the transmission mechanism of lower Fed rates is not as straightforward to lower mortgage rates, because as you alluded to, people need to believe that these rate cuts are indeed required for the economy. And in some ways, if you look at the last couple of months, the jobs market report is showing some signs of fragility, which is then convincing investors that actually the economy genuinely requires lower rates, political pressure aside. And that's why the 10-year rate in the particularly last 3 months, has really come in towards the low end of the range.
Yeah, and that weakness on the labor market, that's been what Powell and the Fed has continuously stressed. But we need to take a short break. Coming up, the massive wave of AI spending that's starting to move the bond market. That's next. Our number of the day is $375 billion. That's how much global spending on artificial intelligence is expected to hit this year, according to UBS, and it's forecasted to reach $500 billion by 2026. We often talk about how AI is as a stock story, right? What's the relation to the bond market? Because I found this really fascinating in your notes.
Yeah, no, it's a very interesting link that I'm starting to think about more and more. Let me first start by saying the AI story, as you said, in the last probably 2 years has been mostly a stock market story, right? It's like investment, capex, the possibility of future high productivity gains. Right now, we're in that phase where we are projecting the world to change or world to sort of evolve based on this AI systems we've been developing. But I do think for the bond market, in the next 6 to 12 months, the rubber meets the road, right? You're going to start to see, given the lofty valuation of the stock market, is that projected dream of productivity gains, is that going to materialize?
Oh. But the question is now, is that they're putting out these projections for 2026, 2027. It seems like we're getting these promises from companies, but you're saying that might not necessarily be the case.
The bubble might pop.
Yeah, so look, I'm not
We're like this, will the bubble pop?
I'm
The question of the year.
Yeah, no, I'm not predicting the bubble to pop or anything. I think my view is in the next 12 months, investors are going to need more direct answers to whether the investments and the leap of faith that the markets have taken in the last couple of years, is that justified or not? And for me as a rates investor, I do see a bit of an asymmetry, right? Because let's look at scenario one. Scenario one is where this AI thing is genuinely going to increase productivity, much like the late 90s. The productivity boost, I think the flip side of that is it might come at the cost of some degree of unemployment rate going up.
Right. And we're already seeing that with
seeing
Amazon, other types of companies announcing layoffs.
Correct. So I think more specifically when you look at the BLS numbers, the unemployment rate for the younger cohorts, the 16 to 24 group, 24 to 35 group, that's the one that seems to have had the most upward pressure. Now, again, it's too early perhaps to draw a very hard conclusion about that's an AI story. But what I'm saying is, if in the next 12 months, AI proves to be the genuine productivity enhancer that people think it is, then the unemployment rate uptick will be more and more attributed to the AI or AI development into various companies. What that will mean for the bond market is there is going to be this disconnect between growth and labor markets. And the Fed's mandate is labor markets.
But would the Fed then need to, I guess, recalibrate what a healthy labor market looks like in that sense? Because if productivity gains are boosting the economy, and at the same time we have a high unemployment rate, maybe the economy can sustain itself if the unemployment rate hovers at a level that we hadn't seen previously.
Yeah, so it's a great question. There's many academic angles you could take. You could talk about this in terms of a lower rate of a higher rate of unemployment, or structurally lower neutral rate. I think what is very plausible in the setup we are in currently is the Fed has had this very imbalanced reaction function. They're always more protective of the labor markets and less concerned about the inflation risks. This is what we've seen in the last 3 to 6 months. In that backdrop, I think the debate is more likely going to go towards where the Fed is, once again, more protective of labor markets. The uptick in the unemployment rate, based on some displacement of AI into the workforce, could cause the Fed to be more dovish in a world of growth holding up and inflation risks also being there. And from a rates perspective, this is a scenario where if AI pans out to be the productivity enhancer, Fed's lowering rates, long-run rates are going up, the yield curve is steepening. But here's the asymmetry. If, on the other hand, this was indeed a bubble, and we have this correction in equity markets, and financial conditions tighten significantly, once again, the Fed's going to end up cutting rates.
Okay.
And so in both cases, in the best case scenario where AI is genuinely changing the workforce versus the worst case where the AI bubble is overhyped, you could see the Fed lowering rates and the yield curve being steeper.
You mentioned something really interesting, and that's the unemployment rate among young people. And we've been covering that a lot. Would you compare this sort of moment to anything else in time where maybe, beyond the financial or recession, is there a moment in time where young people really struggled like this?
Yeah, it's hard to remember a moment like that. I mean, I think the most obvious analogy of this time is the dot-com or the pre-dot-com bust in late 90s, early 2000s. I was looking at that. I think there were a lot of rings of the current macroeconomic situation where productivity was genuinely going up. The labor markets were tight for quite some time. And then starting with the tech sector unraveling in the late 90s, early 2000s, the macroeconomic spillover was pretty significant. So I think to the extent you want to make a correlation between younger people perhaps being more employed in the tech sector, there's a degree of vulnerability there.
So we've been talking a lot about AI and how it's going to affect the economy, the labor market. If you're a bond investor, I mean, is AI ultimately bullish? Because either way, it creates some sort of movement.
Yeah, so look, I mean, it's bullish in the sense that if rates are going to go below the 3.8% on the 10-year.
Yeah, what would that mean? When's the last time we saw rates?
Yeah, that was
low?
Probably, maybe more than a year ago and feels like a long time back.
A lot has happened since.
I know. It feels like that was 5 years ago.
Yeah, there was a different president at that time.
Right.
At that rate. So I think if that happens, it could be sort of this moment where investors start to reconsider the range, and that's when truly rates volatility starts to go up, which, as we discussed earlier, could have broader macroeconomic problems.
Right, again, because it's the range and not exactly the exact number.
And I can't believe because we're almost near this point where we have this October meeting, that we're going to have a December meeting. What are you looking out for as we approach the end of the year? What is a key metric that maybe you're telling your clients, look out for this, and this is what that means?
Yeah, great question. So I think one thing I do think investors are not fully prepared for is the risk of a 50 basis point cut, right? So if you think about the way investors have thought about the Fed cycle currently, we're priced for a 25 basis point in October, a 25 basis point in December, and perhaps a 50% chance or a 60% chance of another rate cut in January next year. I think there's a couple of things investors need to think about a little bit more critically. Number one, if I think about the way Powell has delivered rate cut cycles, there's been two of them, except the COVID one. One was 2019 July. That rate cycle was 3 back-to-back 25 basis point cuts, and then stop and pause for like the next 9 months. Last year, 2024, 3 back-to-back cuts, pause, wait and watch. In that sense, the MO with Powell is he tends to operate in these like small mini cycles, and then he stops and he wants to see how the impact of these rate cuts have been. That window for those rate cuts is open right now. And therefore, in my view, if Powell ever thinks there is a case for a 50 in the next couple of months, he might be much more willing to deliver that in that window when he's delivering rate cuts. He won't like change his mind 6 months later or 3 months later to readjust monetary policy. The second thing to think about in respect to a 50 basis point risk is if you look at Powell, he's on his last 6 months, right? Mm-hmm. There has to be a degree of legacy element in what he does in the next 6 meetings or 6 months. I think by and large for the last 7.5 years, given the challenges for the economy, the tenure has been pretty well received by investors. I think if Powell's faced with this choice of can I do 25 or can I do 50, and it's a close call, I think that small element of like, hey, look, I want to exit when things are generally holding up, you would take the safer choice.
Right.
And that's also where the risk of 50, I think, is a little bit higher. Just to be clear, if investors think the risk is 5%, we think the risk is subjectively, let's say, 10 to 15%.
All right. So the risk of 50 basis point cuts, we talked about the end of quantitative tightening, perhaps, how the Fed is going to commit to more easing ahead. But obviously, all eyes are on that rate volatility, the AI story, how that's going to trickle through into rates as well. But we are winding things down here at Stocks in Translation. Make sure to check out our other episodes of our video podcast on the Yahoo Finance site and mobile app.